A while ago, I had a conversation with a doctor, a man I considered very intelligent, but because he was unaware of one specific tax strategy, he went on to pay an extra $148,000 more in taxes for the year. Money he should have never have paid, and it was completely avoidable. So it got me thinking, if a man as bright and financially savvy as this doctor could make this mistake, then how many other retirees and pre-retirees are out there unknowingly giving Uncle Sam far more than they need? That's why in today's video, we're going to talk about tax loss harvesting, what it is, why and how you do it, examples, and how to avoid this one thing many people forget to think about. So stick around until the end, because if you mess the last part up, the strategy doesn't work. And if I haven't met you yet, my name is Christian Classen. I own 402 Financial. I created this channel to help you make the most out of your retirement. So what is tax loss harvesting? Simply put, tax loss harvesting is a strategy that refers to selling investments at a loss to lower your tax burden. It's important to know that tax loss harvesting can be done only in non-retirement accounts, such as a brokerage or trust account. But when the time comes to sell an investment held in one of these accounts, you'll have to pay taxes on the gains realized. And those taxes can be quite heavy, especially for high income earners like the doctor I just referred to. Now, it's up to 20% federally for long term gains based upon your income. But in the case of this doctor, if you hold on to the investments for less than a year, you face short term capital gains, and they're subject to be taxed as ordinary income, which can be an unbelievable 37%. When you factor in state taxes, even more is piled onto that burden. This is why this strategy is important. The losses you incur can offset your gains dollar for dollar. And this is where tax loss harvesting comes in. Had the doctor opted to sell off some of his underperforming stock, he could have considerably reduced or even potentially wiped out that $148,000 tax liability. And we'll come back to that, but how does one effectively implement this strategy? I'm going to break this down in 3 simple steps. Step 1, look for investments that have a loss. So start by looking at your portfolio to find the underperformers. Look for assets currently trading below the price that you bought them for. And this is where you'll find chances in which you can incur a loss. The second step, you want to offset your losses with gains. So if you've sold any investments at a profit during the year, those gains can be offset with the losses that have been realized. So for example, if someone had $15,000 of gains realized by selling a particular stock, then selling investments at a loss of 15,000, you would zero out the taxable gain. Step number 3, you want to use losses to offset ordinary income. So what if you lose more than you gain? You can use up to $3,000 of those extra losses each year to reduce your regular income, thus lowering your tax burden even more. So let's say we're in a down year. If you have more losses, you can carry them to offset future gains in the years moving forward. So by following these steps, tax loss harvesting becomes a very powerful strategy for minimizing tax liabilities while maintaining a balanced portfolio and even benefiting from the market's ups and downs. Now, if this has already made you rethink how you invest, look at taxes and your plan for retirement, drop a comment below. And if you're curious to see how much you need to retire, I have a how much to retire quiz in the description below. But let's get back to that example with the doctor. Suppose the doctor liquidated a large part of his investment in a particular company and realized $400,000 in short-term capital gains. Now, suppose the doctor also had $360,000 in unrealized losses from other investments. If he had sold those underperforming investments to harvest the losses, he could offset $360,000 of his $400,000 in gains. Instead of being taxed on the full $400,000, he would have only been taxed on the remaining $40,000 of gain. With a tax rate of 37%, his tax bill would have also been reduced from $148,000 to a mere $14,800, a savings north of $133,000 in taxes he didn't have to pay. But remember how I said you don't want to forget this important step? It's called the wash sale rule. And this is one of the biggest pitfalls people face when using this particular strategy. Under the rules of the IRS, if you sell a stock or a fund to harvest a loss, you cannot buy the same or one that's substantially identical within 30 days before or after the sale. If you do, the IRS doesn't allow the tax benefit from the loss. So, for example, let's say you sell shares of Apple, you realize a loss of $5,000. If you buy that same stock within a 30-day period, then the wash sale rule kicks in and you lose the ability to claim the loss. So, you have two possible ways to avoid this. If you want to buy the same investment, you have to wait at least 31 days after the sale date to avoid triggering the rule. But in the meantime, your money's doing nothing, which is kind of far from optimal. The more conservative approach, and in my opinion, the better approach, is to reinvest in another alternative that isn't substantially identical. So, for example, instead of buying the same stock or fund, opt to buy a different ETF or mutual fund tracking that same sector or industry. This not only helps you to diversify the portfolio, but decreases the chance of being inactive with your investment. So while tax loss harvesting may sound complex, I hope I was able to break it down for you. And if you have questions, feel free to leave a comment down below because it's probably one of the smartest ways to save your money from paying extra tax. And if you want to go deeper into retirement planning, watch this next video right here to see how you compare to the average retiree at 60. Don't forget to subscribe for more weekly videos on how to increase your retirement savings and keep more of the money you've earned. I hope you have a great day, and I'll see you in the next video.